Let's talk how this hedge fund made $700 million on the GameStop trade, and in doing so reveals some very important lessons for beginner traders, beginner investors, or veteran traders and investors such as myself, that you never want to forget about these lessons, because at the core, they are foundations from which all strategies are going to need to be built from. And the good news is these are very basic, and in fact, you may hear some of these and think, really, do you really have to tell me this? And yes, I do, because all I would ask you to do is consider other GameStop shareholders, consider other stocks or cryptos or anything that's a financial asset, and you're going to see this underlying mentality not being in place. And when it's not in place, it's costing people opportunity, it's costing people money. In some situations, it's making them go from making money to losing money. And you obviously don't want that to happen. But in looking at how this all broke down, like I said, basic principles, but very, very important principles that you must be using within your trading and investing. So, of course, as I said at the beginning, the fund that made $700 million on GameStop, which is just absolutely crazy. So let's go to the article here. So they were buying under $10. And I bring up that point just because and I just want to clear this up quickly, but there seems to be a common misconception out there that hedge funds, Wall Street equals shorting stocks, equals bad, equals they're all evil because they're shorting stocks and trying to drive them into the ground. Now, I'm not saying that Wall Street, I'm not saying that hedge funds don't short stocks and short financial assets. They do, but to just bring out a broad paintbrush and paint everything as, everybody shorts, that's just not true. Again, this hedge fund, this $700 million was made from buying, from going long. But along with buying, when did they sell? Well, they were selling when the meme stock peaked. And this is the first learning lesson. And that learning lesson is this: they were dating the stock. They didn't get married to it. Have you been there before? I know I have, where you go all in and you just get married to an idea. You refuse to budge. You refuse to reconsider. You refuse to do anything that would go against your original idea. But you need to go into any sort of trade and investment. Now, sure, an investment's a little different, but at the core, you still have to realize that, there are things that can go wrong. There are things that I need to acknowledge that would cause me to behave differently and, sell the asset that I have. So the hedge fund here was clearly there to trade. They were dating GME. They weren't married to it, and you always want to have that mentality. And this is important because if you're married to something, then you're never going to be selling. You're never going to be actually doing what you should be doing, because at the core of the markets, you're here to make money. You're here to be responsible with your money and grow your money. And it's irresponsible to allow yourself to get so into an idea that you just refuse to consider anything else. So the hedge fund here, they never got married to it. They dated it, and that allowed them to ultimately be able to sell them. And like I said, I'm not trying to persuade anybody. All I'm trying to say is maybe this makes, no kidding, Clay, I'm a trader. Of course, I'm not going to get married to an idea. Traders need to be flexible. And I truly hope you realize that. But my point here is, how many people are still married to some of these meme stocks? They are married. They're not going anywhere, even though they've seen money come and go, and that's on them. That's fine. But what I'm getting at is let's learn from hedge funds. Let's learn from somebody that made $700 million on a stock. And what were they doing? Well, they were doing the exact opposite of being married to an idea. They were flexible. They were dating the idea, which allowed them to ultimately be able to capture $700 million. So I'm sure you've already read the title of this article and you know what the sell signal was. But just in case, what was the sell signal that they used? An Elon Musk tweet. So, and this is, can you envision? I can envision this, and I can envision just pretty much such a simple yet powerful conversation taking place. But his piling on was that tweet for us was, we all looked at each other and thought, how do you top that? I agree. Elon Musk is now tweeting about something when it's already been crazy. I mean, how does it get any better than that? When things have already been so crazy and now you have Elon Musk tweeting about it, I understand what they're doing. And what they're saying is, from an emotional standpoint, from a hype standpoint, wow, I mean, it's been great, but I mean, can it actually get any better than that? And so for us, that signified peak momentum and proceeded to exit. Now here's the next learning lesson: the rest of our position. Exit the rest of their position. and that is pay yourself. Very clearly, if they were selling the rest of their position, that means they'd already sold some first. So as the stock was going up, because of number one, because they weren't married to it, they were saying, and rightfully so, hey, you know what? Let's pay ourselves. Let's lock in some gains, right? Let's lock in some profit. That's just terminology for they were selling some of their shares already on the way up. Now, of course, the article doesn't say at what price levels, but again, the idea here is, and the big learning lesson is, it's always smart to pay yourself during a trade. And when I was a beginner, I always was under the impression, and I'm just making this up, if I bought 100 shares of something, when I was ready to get out, that means I had to sell 100 shares. But no, you can scale out. You can sell 10 shares if you want. You could sell 25. You could sell 50. But you do not have to sell all 100 shares. So don't fall into that pit trap that I remember falling into, meaning if you bought 100, when it's time to sell, that means you sell 100. No, you can do partial sells. You can sell 25, so on and so forth. But that's what the hedge fund was doing, is they had already been paying themselves. And it sure is easier to follow a trade plan when you're locking in profit, when you're paying yourself. And again, that's fine if you want to disagree with me. And I say this all due respect, but I'm going to try to learn from people that make $700 million on a trade, not from somebody that's sitting here saying, calling people a troll and hater because they sold out already. Okay, that's fine. But like I said, and I'm not saying this is towards anybody. I'm just saying in general, if you're living in your parents' basement, I'm not, I'll hear you out. I'll listen to you, but I'm probably going to be erring on the side of, what are the hedge funds that made $700 million? What were their approaches to the market? And their approach was very simple so far. They clearly were not married to this idea, and they were paying themselves. They were slowly scaling out on the way up. And then I want to go back, and I've kind of already alluded to this, but it is so important. But when they were thinking, well, how do you top that? How do you top an Elon Musk tweet? And that is trade the emotions. Now, not be emotional. I realize my slogan on the site is trade without emotion. So I'm not saying that they were emotional. What I'm saying is they were trading other people's emotions. And in their mind, as soon as that Elon Musk tweet came out, basically saying, can this thing really get hyped up anymore? Now, the price did go up a tad bit more after that tweet. So sure, that didn't nail the top, but I suppose I could make that a learning lesson too. If you're expecting to always nail the top, then you're not being very realistic with yourself. But we'll put that aside. But the idea here is that what is a hedge fund doing? They are just looking, they are thinking, okay, what's the emotional climate out there? Wow, it's very, very hyped right now. Wow, there's even more people talking about it. Wow, it's even hyped up even more. Oh my, Elon Musk just made a tweet on it. Okay, I'm not quite sure anybody, I don't think there's anything that can top an Elon Musk tweet. And sure, they didn't nail the top, but they were pretty close. But at the end of the day, when you boil it down to the hype factor, yeah, they were just analyzing. They were trying to figure out what exactly is going on with the hype. And in their mind, when the hype was finally over, that's when they decided, because they were not married to the play, because they already paid themselves, you know what, let's just exit the rest. But they weren't caught up in the hype. If you've heard the slogans, don't drink the Kool-Aid, they were not drinking the Kool-Aid. They were remaining level-headed. They were playing the emotion, but again, not their emotions. They were playing the emotions of others. And when others were just screaming to the moon, they were selling into that pressure. They were selling into the hype, which again is what you want to do. Pay yourself, but also admit at some point, you know what? I think this is mass hype, so it's time to fully exit out and put $700 million in your pocket. And then to wrap things up here, Michelle, who was the hedge fund guy, decided to buy shares of GameStop in September 2020 amid a slew of analyst sell ratings and unprecedentedly high short interest. It's a classic contrarian play for us. Now, let's go on to the last lesson here, but this one's a little sketchy, but there is still definitely a learning lesson in it. And that is, don't be a sheep. You've got to learn to think for yourself. And in this situation, they were doing the exact opposite. They were taking a contrarian move. Ratings after ratings after ratings from the analysts were sell, and they were buying. So you've got to learn to think for yourself. You can't be a puppet. You can't be a sheep where you just walk around and expect everybody else to always tell you what to be doing. But this one is tricky because in some situations, and I'm not saying to listen to the analysts, but in general, there are a reason why a lot of people are not doing certain things. There's a reason why lots of hedge funds, for example, are not looking at a dividend, for example, that pays a 40% yield and saying, wow, what a great deal, 40% dividend yield. Because they understand, well, there's there's more that goes into it than a 40% yield. And when a bunch of people are not doing it, it's because, well, you know what? How did the yield get up to 40%? So there's some things where, yeah, be a sheep, because being a sheep is what matters. And if you think that you can go load up your portfolio with 40% yields for dividends, then like I said, you're getting a little too fancy for things, and you need to stick with what works. So yes, in some situations, be a sheep because they're proven concepts, and just because everybody seems to do it, that doesn't mean, for example, hey, you know what? Seems like everybody's putting money in IRA accounts. Yeah, I don't want to be a sheep. Oh, well, no, there's a reason why everybody's putting money in IRA accounts or 401k, because they're tax friendly. They allow your money to grow that much better. But in other situations, you can't walk around and say, tell me what to think for myself. I don't want to learn how to think. If that's what they're saying, then so be it. But like I said, there is a balancing act here. So this one gets a little sketchy, but at the core, I do love how the hedge fund was willing to think enough for themselves, where despite a lot of analysts out there putting sell ratings, they still decided to buy. But that's how you make it. That's how you do it. And at the core, nothing fancy from a behavior standpoint, from a trade management standpoint. Don't get married to anything. Just make sure you're dating. Pay yourself on the way up, okay? Just because you sell doesn't mean you have to sell your entire position. You can do partial sells, pay yourself on the way up. Trade the emotions of others. Don't be emotional. So figure out the hype, figure out the fear if you're some sort of short, but play the emotions of others, and then, yeah, don't be a sheep. So I found this very helpful, these articles, because when you just kind of look and read between the lines, you're saying, okay, yeah, I already knew that, but hey, good reminder to know that I'm practicing the same sorts of trade management strategies that, hedge funds are doing that, have a whole lot more money than I have and that are making $700 million on a trade. So if you enjoy videos like this where I take down articles and kind of break them down, let me know, or link an article down below if you'd like me to look at that. Maybe you do a video like this on an article that caught your eye. I can't make a promise that I'll do it, but I'm always looking and appreciate any sort of feedback from you viewers. So if there is an article that you want me to look over, definitely let me know. If you enjoy this video in general, smash that like button, leave a comment down below. Your help in that regard always goes a long way. And as long as I'm getting communication, that always helps me to know what sort of content to continue to put out for everybody. Then finally, check out the channel as a whole. Watch a couple other videos. And if you like what you see, then I would definitely love to have you as a subscriber to the channel. But get out there, take these 4 learning lessons and apply them to your trading and investing. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only 1 losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.